Welcome to this custom-tailored deep dive. We've got a massive agenda today.
It's huge.
Yeah, and if you are staring at your portfolio, reading the macro tea leaves, or just trying to wrap your head around the sheer velocity of the markets right now, you probably know exactly what we're dissecting today. We are looking squarely at the 2026 artificial intelligence landscape.
But, and this is crucial, we are entirely bypassing the consumer-level hype.
Right, no talk about chatbots, no image generators. We are tearing into the colossal ground-level infrastructure build-out.
The plumbing?
Exactly, the plumbing, the high-stakes race for these trillion-dollar mega-IPOs that is currently, frankly, fracturing Silicon Valley's traditional venture model.
He's completely breaking it.
And we're going to look at the rather stark, sometimes contradictory stock market realities that are catching a lot of institutional investors off guard.
Because the scale of what we're watching unfold right now is genuinely historic. I mean, we are tracking a volume of dedicated capital expenditure moving through the global economy that eclipses the build-out of the early internet infrastructure.
Which is wild to think about.
It is. In some metrics, if you adjust for inflation and GDP parity, it rivals the capital mobilization of the transcontinental railroads.
Wow.
Yeah. And to really map this out, we aren't just relying on, op-eds or Twitter threads. We have aggregated a mountain of elite financial and strategic intelligence.
Heavy-hitting sources today. We are pulling directly from Vanguard's 2026 Economic Outlook. We've got Goldman Sachs' highly scrutinized deep dive report on AI capital expenditures.
This one is dense.
Very. We also have Fidelity's latest AI market outlook, BlackRock's new market playbook. And on the corporate strategy side, we're factoring in PwC's 2026 AI business predictions and Morgan Stanley's key investment themes.
Right. And to ground all of that macro theory in actual equity performance, we are cross-referencing it with the absolute latest stock analyses and market breakdowns from the Motley Fool and NASDAQ.
So our mission today, our mandate, is ruthless pragmatism. We are stripping away the speculative fat to decode this massive influx of capital.
We want to track the actual dollars, where they originate, the physical assets they are purchasing, and the expected yield.
The goal is to build a clear, actionable picture of what is structurally sound, what is fundamentally over-leveraged, and where the most asymmetric risks lie in the 2026 market.
And we are speaking directly to you, the learner.
Yes. Whether you are rebalancing a highly concentrated 401k tech portfolio or you're prepping the macro slides for your firm's quarterly strategy offsite.
Or you're just insanely curious how orbital data centers.
Yes, actual space data centers.
How those transition from a sci-fi subreddit into a leading headline in the Financial Times.
We know you already understand the basics of how these models function. Today is about the economics, the physical constraints, the strategic chessboard.
This deep dive is your ultimate shortcut to being well-informed on the realities of 2026.
Okay, let's unpack this. Let's start with the absolute financial gravity of this situation. The $500 billion capital expenditure boom.
The sheer velocity of the upward revisions is what really stands out in the Goldman Sachs data.
It's staggering.
It is. Wall Street analysts have consistently, for the last 3 years, failed to model the upper bound of what the hyperscalers are willing to spend.
And when we say hyperscalers, we mean Amazon, Microsoft, Alphabet, Meta.
Exactly. For 2026, Goldman's consensus estimate for hyperscaler AI capex has violently surged to $527 billion.
$500 billion.
Yeah.
In a single 12-month cycle. And just a few months ago, that exact same Goldman model had the estimate sitting at $465 billion.
Right. The baseline just keeps shifting upward every quarter.
If we look at the historical comparisons in their report, the absolute peak of the late 90s telecom boom, adjusted for today's GDP, maxed out around $700 billion.
So we are within striking distance of the largest single-sector infrastructure spend in modern economic history.
But Goldman Sachs also notes the friction here. Why this specific number right now? What is the technical catalyst forcing their hands in 2026?
It's the transition to agentic AI, which the PwC report details extensively.
Let's define that, because it's not just a buzzword anymore.
No, it's a fundamental architectural shift. The models from a couple of years ago, the ones that started the hype, they were essentially reactive lookup engines. You prompt, it infers, it outputs.
Like a very smart search engine.
Right. The compute was heavily front-loaded in the training phase, while the actual running of the model for the user was relatively lightweight.
But agentic AI flips that script entirely.
Completely. PwC is tracking the deployment of centralized, enterprise-wide agentic platforms. These agents are tasked with multi-step autonomous workflows.
They aren't just drafting an email anymore.
Exactly. They are pulling active data from a massive enterprise SQL database, running comparative analytics, identifying underperforming supply chain nodes,
Drafting a mitigation strategy.
routing it through compliance APIs, and executing new vendor contracts, all autonomously. They are reasoning and maintaining context over hours or even days.
And that continuous reasoning, that loop of planning, executing, evaluating, and correcting, that requires a staggering amount of inference compute.
You are essentially forcing the model to run continuous recursive loops. From a hardware perspective, supporting thousands of concurrent enterprise agents doing this,
For Fortune 500 companies.
right, it requires fundamentally more silicon than the reactive models did. The hyperscalers are staring down the barrel of an absolute compute deficit.
Meaning if they don't buy the chips now, they physically won't be able to run the software their clients demand.
Precisely. If Microsoft or Amazon cannot provide the raw flops required for their enterprise clients to run these agentic frameworks, they will lose enterprise cloud market share, period.
So that $527 billion isn't just visionary spending.
No, it is defensive survival spending.
Which pivots us perfectly to the actual hardware layer. The companies that Fidelity has aptly named the captains of compute.
I love that term.
It's great. They are the primary beneficiaries of this defensive CapEx panic. And the entire stack still rests on Nvidia.
Always does.
The NASDAQ and Motley Fool data show Nvidia's revenue clearing an astronomical $130.5 billion in 2024. But the 2026 story is all about the Rubin architecture.
Because NVIDIA's dominance at this stage isn't just about the GPU anymore. It's about the entire data center architecture.
Right.
The Rubin platform is a complete overhaul of how data moves within the cluster. But the metric that NASDAQ highlighted, which is frankly hard to wrap your head around, is the forward visibility.
This is the crazy part.
Yeah, NVIDIA's leadership reportedly has visibility into $500 billion in Blackwell and Rubin revenue through the end of 2026.
Having $500 billion of locked-in, or at least highly probable, forward pipeline in a hardware business.
That's unheard of.
It completely breaks traditional cyclical hardware modeling. You just don't see that.
And with Rubin, we are seeing a massive push into reducing the inference costs, which aligns perfectly with that shift to agentic AI we just discussed.
They are tightly integrating next-generation high-bandwidth memory and fundamentally altering the networking topology to make running these autonomous agents cheaper per token.
But that paradoxically just incentivizes the hyperscalers to buy more racks.
To build even larger superclusters.
Yeah.
Jevons paradox in action.
Exactly. The design is flawless, but we have to remember NVIDIA is a fabless company. They don't pour the silicon.
They design the blueprint, but they don't build the house.
Right. And that brings us to the ultimate choke point of the global economy. Taiwan Semiconductor Manufacturing Company, TSMC.
TSMC is both the great enabler and the great bottleneck here.
Fidelity's analysis zeroes in heavily on TSMC's advanced packaging capabilities, specifically their CoWoS technology, chip-on-wafer-on-substrate.
Because it's no longer just about shrinking the transistor, right?
No, we're hitting physical limits there. It's about how you physically stack the logic dies and the memory modules right next to each other so the data doesn't have to travel as far.
The physics of moving data across a traditional motherboard is just too slow.
Too slow and takes way too much power. But that CoWoS packaging process is incredibly complex. It's prone to defects, and it is severely capacity constrained.
So TSMC is aggressively expanding this advanced packaging capacity. They're aiming for roughly 130,000 wafers per month by late 2026.
But the NASDAQ report points out that NVIDIA has essentially cornered that market. They've secured roughly 60% of TSMC's entire advanced packaging volume.
60%. That is a brutal flex of market power.
It leaves companies like AMD and even the internal hyperscaler chip projects fighting over the remaining scraps.
And that fight for the remaining capacity is exactly why Broadcom has become such a critical pillar in this ecosystem.
Broadcom is fascinating here. They are dominating the custom silicon, the ASICs, application-specific integrated circuits.
Because Google has their TPUs, Amazon has Trainium and Inferentia, Microsoft has Maya.
Right. They're all desperate to reduce their reliance on NVIDIA's margins because NVIDIA's margins are massive.
But designing a world-class AI accelerator from scratch is a monumental engineering feat.
So Broadcom acts as the mercenary engineering force. They take the hyperscalers' architectural concepts and actually make them work at scale, getting them ready for tape-out at TSMC.
And the Motley Fool points out Broadcom is commanding an estimated 60% market share in the AI server ASIC market.
Furthermore, when you build a cluster with 100,000 GPUs, the networking switch fabric required to keep those chips communicating without latency bottlenecks is immense.
You can't have chips waiting around for data.
Exactly. Broadcom's Ethernet switches are the backbone of that non-Nvidia networking fabric. This dual dominance in ASICs and networking is why Broadcom is sitting on a $73 billion AI-related backlog.
$73 billion. And that isn't a projected pipeline. That is a contractual backlog.
Real orders.
And the final piece of the silicon puzzle here is the memory. Faster logic is entirely useless if it's starved for data.
Which is why Micron is riding an unprecedented wave. The Rubin and Blackwell architectures require massive pools of HBM high-bandwidth memory.
And because the yields on manufacturing HBM are historically tricky, the supply is very tight,
Giving Micron massive pricing power in 2026. It's the classic memory wall problem. You can scale the processing power all you want, but if you can't feed the data fast enough, the processor sits idle.
burning expensive power while doing nothing.
Exactly. Micron's ability to deliver high-yield HBM density is a massive differentiator in the 2026 supply chain.
So looking at these captains of compute, the financials are just staggering. The Magnificent Seven tech stocks are posting mid-20% earnings growth.
While the rest of the S&P 500 is essentially flat or grinding out low single digits.
From a purely fundamental perspective, these high valuations we're seeing are backed by massive multi-year revenue ramps.
The hyperscalers have the cash, they are spending it, and the hardware companies are booking the revenue.
It looks like a sustainable structural boom.
What's fascinating here is that Vanguard completely rejects that premise of sustainability.
Really? Completely rejects it.
Yes. Their 2026 economic outlook introduces a massive contrarian warning. They are explicitly calling out AI exuberance.
Okay.
And they are targeting the exact CapEx numbers we just discussed. They note that the broader AI ecosystem has made $2.1 trillion in historic capital commitments through 2027.
$2.1 trillion. But wait, the hyperscalers print money? Microsoft and Google have fortresses for balance sheets. Are they really at risk?
Vanguard's argument isn't about Microsoft going bankrupt. It's about the net present value, the NPV, of these specific data center investments.
The return on invested capital.
Yes, they have cash, sure, but they're increasingly using complex debt structures, massive public bond issuances, and private credit to accelerate this build-out without completely draining their cash reserves.
So they're leveraging up to build the infrastructure.
Exactly. And Vanguard is questioning the terminal value assumptions in the financial models justifying this debt.
Let's dig into that math because it gets tricky. The hyperscalers are spending $527 billion this year. They are capitalizing those servers over, say, 4 to 5 years.
Right.
So Vanguard is arguing that the future cash flows generated by selling API access to these agentic models might not actually cover the depreciation of the hardware, the massive energy costs, and the cost of the debt used to build a data center in the first place.
Precisely. The discount rates being applied to these infrastructure projects might be dangerously low given the execution risks.
Give me an example of the execution risk there.
Well, if an enterprise client realizes that an agentic workflow only saves them $10,000 a month in operational costs, they aren't going to pay Amazon $20,000 a month for the compute to run it.
The math doesn't work for the end user.
Right. If the unit economics of the software layer fail to materialize at the necessary premium, the entire hardware investment goes negative NPV.
And Vanguard points to the late 90s telecom boom as the historical precedent for this.
Yes, and it's a very apt comparison. The telecom companies laid millions of miles of dark fiber. The technology was real. It literally built the modern internet.
It radically expanded global GDP.
It did. But the companies that borrowed billions to lay the fiber faced absolute annihilation in the public markets.
Because they overbuilt capacity too quickly.
Yes, leading to massive margin compression and debt defaults. Vanguard is warning that we could see a repeat.
A world where AI changes the global economy. But the tech-heavy U.S. stock market still faces a brutal correction because the infrastructure builders over-leverage their near-term bets.
That is a critical distinction for investors to understand. The technology succeeding does not guarantee the stock prices of the infrastructure providers will hold.
That is sobering. But if Vanguard's warning about the public markets is sobering, here's where it gets really interesting. Let's pivot to the private markets.
Because the capital dynamics there have reached a literal breaking point.
We are looking at a $160 billion plus wave of mega IPOs, all queuing up for 2026.
The sheer scale of the liquidity that these private entities are attempting to draw from the public markets is unprecedented.
We are looking at the foundational titans of the generative AI era, all racing for the exit door simultaneously. Let's start with the one that genuinely reads like a sci-fi script.
I know exactly which one you're going to say.
It's currently being modeled by every major investment bank on Wall Street, the SpaceX and xAI merger.
Yeah.
As of February 2026, this merger was finalized, creating a combined entity with an estimated private valuation hovering around $1.25 trillion.
Trillion. With a T.
And the strategy isn't just cross-selling software to aerospace engineers. They are fundamentally fusing AI infrastructure with low Earth orbit capabilities.
The proposition of orbital data centers and solar-powered compute nodes is perhaps the most audacious engineering gamble of the century.
It sounds insane, but break down the logic for us.
The logic directly addresses the terrestrial bottlenecks we are seeing. Down here on Earth, hyperscalers are fighting local municipalities over zoning.
They're fighting over water rights for cooling towers,
facing years-long delays just to connect to the power grid.
So the thesis is, bypass the Earth's grid entirely.
That's the pitch. In space, you have access to unencumbered, continuous solar radiation, assuming the orbital mechanics are optimized. You don't need a massive utility substation.
And the cooling.
Furthermore, the ambient temperature of space offers a radically different paradigm for thermal management.
Now, to be clear, operating high-performance GPUs in a vacuum.
While managing cosmic radiation?
Yes, and the immense difficulty of dissipating heat without atmospheric convection. That presents massive, potentially insurmountable engineering friction.
Not to mention the launch costs. You still have to get 10,000-pound server racks into orbit.
Right. But with the cadence and payload capacity of Starship, the economics per kilogram have dropped to a point where this is no longer mathematically impossible.
It's merely extremely difficult.
And the laser inter-satellite links they developed for Starlink provide the high-bandwidth, low-latency backhaul required to actually transmit the processed data back to Earth.
The narrative is incredibly potent, and they are eyeing a blockbuster IPO for July 2026.
A $1.25 trillion company going public mid-year would be a gravitational event for the S&P 500.
It would force a massive reweighting of index funds across the board.
But they are not acting in a vacuum. OpenAI, the company that effectively catalyzed this entire cycle, is actively preparing for a Q4 2026 IPO.
And the whispered valuations there are north of $830 billion.
And we cannot ignore Anthropic. They have surged to a $350 to $380 billion valuation.
Their revenue trajectory has been violent in the best way possible. They recently cleared $14 billion in annual recurring revenue.
$14 billion ARR, primarily by capturing the highly regulated enterprise sector, banks, healthcare networks.
Using their constitutional AI framework to guarantee safety and compliance, they are projecting to cross $18 billion in ARR in 2026.
And they are prepping their S1 for the second half of the year.
So let's sum that up. We have a $1.25 trillion space compute conglomerate,
An $830 billion market creator,
and a $380 billion enterprise darling, all attempting to go public within a 6-month window.
The combined market cap is approaching $2.5 trillion.
The obvious question is, why now? Why not stay private? Silicon Valley has spent the last decade perfecting the art of staying private longer to avoid Wall Street scrutiny.
Right. It's the capital crunch, isn't it?
It is entirely the capital crunch. This isn't a traditional tech IPO where early employees just want liquidity for their options so they can buy houses in Tahoe.
This is existential.
Look at the leaked OpenAI infrastructure documents from a while back. They mapped out a requirement of roughly $115 billion in dedicated infrastructure funding through 2029.
Just to build the gigawatt-scale supercomputers necessary to reach artificial general intelligence.
Yes. And venture capital, even if you aggregate the dry powder of Sequoia, Andreessen Horowitz, and Thrive,
they cannot sustain $115 billion in pure hardware capex.
They absolutely cannot. Venture capital is designed to fund software margins, not heavy industrial infrastructure. Even the sovereign wealth funds are beginning to balk at the concentration risk.
The private markets have been exhausted by the burn rates required to train these frontier models.
They must access the deep, liquid pools of the public markets. Pension funds, retail investors, mutual funds, that is the only way to finance the next phase of the compute war.
But both the Goldman Sachs and Morgan Stanley reports flag a massive structural risk here. Can the global public markets actually absorb a $160 billion liquidity drain in a single year without breaking something?
It's highly questionable because when these companies file their S-1s, the opacity of Silicon Valley vanishes.
The kimono opens.
Wall Street analysts will tear into their gross margins. They will look at the cost of compute versus the revenue to token.
And if the path to gap profitability is obscured by massive stock-based compensation and hardware depreciation.
The public markets might aggressively reprice these assets downward upon listing.
And then there's the governance collision. The public markets demand standard corporate governance, a fiduciary duty to the shareholder.
That is going to be a fascinating legal and structural battle to watch play out. OpenAI, for instance, has a highly complex capped profit structure overseen by a nonprofit board.
Ostensibly to prioritize AI safety over infinite shareholder return.
Right. Anthropic operates as a public benefit corporation. Wall Street fundamentally distrusts esoteric governance structures that limit their upside.
Or prioritize abstract safety goals over quarterly earnings.
Exactly. Reconciling those foundational charters with the demands of institutional shareholders is going to create massive friction during these roadshows.
It's a high-wire act. They have to go public to fund the hardware. But going public exposes the brutal underlying economics of the models, which could tank the valuations they need to raise capital.
It's a catch-22.
So what does this all mean? If you're staring at this landscape, the $500 billion in CapEx, the massive IPOs, the debt warnings.
How do you actually position a portfolio?
Exactly. Let's pivot to our third segment, the physical realities and the broader indirect plays. Because the physical constraints are rapidly becoming the primary dating factor for the entire industry.
Morgan Stanley's research is incredibly stark here. We are no longer just constrained by TSMC's packaging.
We are constrained by the fundamental limits of the electrical grid.
Morgan Stanley expects U.S. energy consumption driven solely by these data centers to rise 10% per year over the next decade.
A 10% annual increase in base power demand is functionally unheard of in modern times.
For the last 20 years, power demand in the developed world has been relatively flat. We adopted LED lighting, more efficient HVAC systems.
Grid operators plan for a low-growth, highly predictable environment.
And Fidelity is calling this new era a power renaissance. They note that AI is completely reversing that multi-decade trend.
The math is brutal. A next-generation AI training cluster housing hundreds of thousands of GPUs can require over a gigawatt of power.
A gigawatt. That is the output of an entire nuclear reactor dedicated to a single facility.
And you can't just power a gigawatt data center with a solar farm and a few batteries.
No, because AI training cannot tolerate intermittency. If a wind turbine stops spinning and the power dips,
you don't just lose a few seconds of work.
You can corrupt an entire training run that cost millions of dollars to initiate. These facilities require 24/7 ultra-reliable baseload generation.
Well, the tech industry loves to talk about small, modular nuclear reactors.
The regulatory and construction realities mean those won't be online in meaningful numbers until the 2030s.
Which brings us to Fidelity's core near-term thesis, natural gas.
It is the only baseload power source that can be scaled up and permitted fast enough to meet the 2026 and 2027 demand curves.
Exactly. This dynamic is what makes the picks and shovel strategy so compelling right now.
If the pure-play AI models and the mega-IPOs seem too highly valued or too risky, you look at the heavy industrial companies.
The ones that must build the physical infrastructure regardless of whether OpenAI or Anthropic wins the software war. We are looking at companies entirely outside the traditional tech sector.
Like GE Vernova.
Yes, GE Vernova. If Fidelity is right, and natural gas combined cycle plants are the bridge fuel for AI, GE Vernova is the apex predator in manufacturing those massive gas turbines.
Their order books are surging as utilities scramble to add dispatchable power.
And the power delivery within the data center itself is incredibly complex. Stepping down power from a high-voltage transmission line to the precise voltage required by a server rack.
Without blowing the circuits.
It requires massive, highly engineered switchgear and uninterruptible power supplies. Companies like Eaton are seeing explosive backlog growth, specifically from hyperscaler contracts.
We also have to talk about thermal management, because pushing 1,000 watts through a single chip generates a terrifying amount of heat.
Air cooling is physically obsolete at this density.
Trane Technologies, a company most people associate with office building air conditioning, is deeply embedded in the direct-to-chip liquid cooling systems.
and the massive chiller plants required to keep these clusters from literally melting the silicon.
You even have companies like Sterling Infrastructure. Before you can install the servers, you have to buy a massive tract of land, clear it, pour tens of thousands of yards of specialized concrete, and build the physical shell.
Sterling's site preparation business is operating at absolute capacity.
These are tangible, cash-flowing industrial businesses trading at fractions of the multiples of the software companies. Yet their growth is entirely tethered to the AI capex boom.
And there's a highly specific leveraged play in the energy markets that the BlackRock report highlights. Independent power producers, or IPPs.
Companies like Vistra.
Yes. This requires understanding the difference between a regulated utility and an IPP. A regulated utility has a guaranteed customer base, but their profit margins are strictly capped by state public utility commissions.
They can't price gouge.
But an IPP operates in the deregulated wholesale power markets. They own generation assets, and they sell that power at the prevailing market rate.
When a hyperscaler drops a gigawatt data center in a region like the PJM Interconnect on the East Coast, the reserve margins of the grid plummet.
The market price for power spikes violently.
Vistra can capture that entire upside. They can sell their power into the wholesale market at those elevated prices.
Or sign highly lucrative long-term direct purchase agreements with the data centers, capturing margins that regulated utilities are legally prohibited from realizing.
If we connect this to the bigger picture, this is the core of the BlackRock and Vanguard strategy for 2026. They are tracking a massive market rotation.
The easy trade, just buying the Magnificent Seven tech monopolies blindly, is over.
We are entering a period of massive dispersion. Institutional investors are getting discerning.
They're looking at the balance sheets of companies funding this infrastructure with debt, looking at Vanguard's NPV warnings, and they are hedging.
They are moving capital into the tangible infrastructure plays we just discussed, into private credit funds that are financing the data centers, and crucially, into international value stocks.
That last point is the true long-term play.
BlackRock notes that the ultimate winners of the AI revolution might not be the tech companies at all.
It will be the legacy sectors. Global financials, healthcare networks, industrial logistics firms.
The ones that successfully integrate these agentic AI platforms to permanently lower their operating costs and expand their margins.
You want to own the bank that uses AI to automate its entire compliance and underwriting division, drastically increasing its profitability without having to spend billions training the model itself.
It's the transition from investing in the architects of the technology to investing in the ultimate consumers of the technology.
That is the rotation defining 2026.
And it highlights why the market is so incredibly complex right now. You have structural growth happening simultaneously with historic valuation risks.
Which brings us to our closing takeaways and our macro outlook for 2026. If we synthesize these massive reports down to their core essence, 2026 is the year the AI narrative fundamentally breaks out of Silicon Valley.
It transitions from private venture capital experiments into massive, heavily scrutinized public market realities.
The primary directive from Vanguard, Goldman, and Morgan Stanley is to expect severe structural volatility.
When you combine the potential liquidity drain of $160 billion in mega-IPOs with Wall Street actively interrogating the return on investment of a $500 billion capex sprint,
you will see violent repricings. The market will relentlessly test the fundamental unit economics of these AI models.
But the secondary directive is equally clear. Do not bet against the structural demand for compute.
Even if the models face latency issues, even if the IPOs price lower than their private rounds, the physical data centers must be built.
The power generation must be modernized. The cooling systems must be deployed.
And if the software execution aligns with PwC's projections, if agentic workflows truly penetrate the Fortune 500, the macro upside is staggering.
Vanguard's economic modeling includes a scenario with up to a 60% probability that AI-driven total factor productivity pushes the U.S. GDP growth rate to a sustained 3% trend over the long term.
A sustained 3% GDP growth rate would fundamentally alter global capital flows.
It would lift almost every cyclical sector of the economy.
We are watching the rewiring of the global economy in real time, backed by capital flows that defy historical comparison.
It's incredible to witness.
It is. But before we sign off, we want to leave you with one final, slightly provocative angle to consider, drawing on the convergence of everything we've broken down today.
We spent a lot of time discussing 2026 as the year AI agents master complex, multi-step, autonomous workflows.
We talked about the trillions of dollars of capital at stake and the labyrinth of Wall Street modeling required to underwrite these massive IPOs.
So consider the timeline and the trajectory of these capabilities. If these agentic models are currently being deployed to analyze massive enterprise SQL databases, optimize supply chains, and autonomously execute operational strategy.
How long until these same AI agents are the entities actively running the real-time load balancing of the national power grid?
How long until they are executing the algorithmic high-frequency trades based on their own real-time ingestion of satellite imagery and global shipping manifests?
And perhaps the most paradoxical thought of all, considering the massive complexity of an S1 filing, the financial modeling required to determine a discount rate, and the risk analysis required for underwriting.
How long until an autonomous AI agent is the primary entity drafting the prospectus, modeling the terminal value, and fundamentally underwriting the very IPO of the company that coded it?
When the core product being sold to the market is intelligence itself, the traditional feedback loops of capital, creation, and valuation begin to fold in on themselves very, very quickly.
It's a completely new paradigm.
Thank you so much for joining us on this deep dive. We know we covered a tremendous amount of ground today, from the physics of CoWoS packaging to the macroeconomics of global liquidity.
We hope this has given you the definitive, actionable shortcut to understanding the colossal forces shaping 2026.
Keep learning, keep a close eye on the physical infrastructure build-out, and keep questioning the changing world around you. We'll see you next time.